Well, the market shouldn't be looking for comfort here. I mean, that's what, that was the whole point of Powell giving a very short speech, was to make sure that the message was very clear. Now, let's see him follow it up later today. But there isn't comfort here. And the problem is for the market is that, and why it should not find comfort, is because from the period since the 08-09 recession, the U.S. economy has been floated by an asset inflation. You don't have a leverage issue, right? Households delevered over the last 10 years. And even business, if you look at debt less cash as a percent of revenue, it's pretty much unchanged. So the leverage isn't there. So the borrowing isn't there for higher interest rates to curtail, and then the economy slows as a result. What you have is the two-pronged attack, which I've written about for a few years now, is the dollar and the equity markets through its wealth effect, through its signaling, and other things. So there shouldn't be. And the issue about 5% is really a question of how long is the Fed going to take to get the funds rate up over the inflation rate. And as I said, I started out by saying it's a bit of a game, because the inflation rate is going to decelerate. But if the inflation rate settles in at 5-6%, to think that 4.25 is the right number, it's not. And you're going to start to come into another year of wage negotiations, and people are going to say, look, even if the inflation rate's lower, my cost of living is higher. They're going to want that adjustment. You have a tight labor market. This idea that, oh my gosh, they're going to create a hard landing, he's told you that. This is the object. The object is to run growth below trend, which in the U.S. is about 1.8%, and increase the unemployment rate, right? He says, create slack in the labor market, which is just a nice central bank way of saying throwing people out of work. And it's an unfortunate thing. It's especially unfortunate because it's a cycle that they've created. Right. And I suspect if we do get a recession, like I believe we are, with an ultimate or a high point of 5.5-6% in unemployment, there'll be a political issue next year in front of Congress, but we'll let next year take care of itself.
Right, Stephen. So what does this mean as we talk about a hard landing for Main Street? Because the consumer, as we know, came out of the pandemic. They had pent-up savings. They were spending that money. They've had a fairly strong run in terms of going to the employer for the first time in many years, saying, I want bigger wages, I want bonuses. How does this change? What does next year look like for that same consumer, from the housing market to what they're willing to spend at the shops?
Well, 5.5-6% is a high unemployment rate. It's not as high as we've had in the past. It always depends on who's unemployed, right? And so if you're the one that's unemployed, it's a very unfortunate circumstance. But what it's going to mean is going to be more downward pressure on prices. I don't think it's going to be particularly deep, maybe 2 quarters of -1.5% GDP growth. And then a slow rebound after that. I think for the housing market, there's a lot of pent-up demand. I think housing is seeing at the moment really, just like computer chips have had surge prices, homes had surge prices. And those surge prices are coming off, and when they write themselves to the much higher mortgage rates, people will buy houses again, because demographically, we're set up for a strong housing market in the United States over the next 5-10 years. So it's short-lived. It's not going to be fun. And I think the most, and those who have listed equities are going to be the one who are going to see the biggest hole in their balance sheets, because that's where the imbalance is. And slowly, the world will work its way back to recovery, and life will go on.